Hey everyone, thank you for tuning into another episode of the What Matters podcast. I'm here with my co-host Ashley Ward, and today our guest is Mr. Erik Jefferson with Flagship Harbor Advisors. Erik, welcome so much to the show. I appreciate you taking your time out of your day to join us. And we had I had some questions I wanted to get this started off with, and thank you again for taking the time with us. Um, I'd like to know a little bit about your origin story. I do know that you were quite an athlete. You got a puppy named Lewis, and you're up there in the Northeast. And for starters, there, how did you build your RIA? If you could share the inspiring journey behind building your company, um, that'd be something I'd love to gain knowledge of.
No, great. And Mike, you've certainly done your research. I think you're probably the first person that's gone through all the lines of the Bible there. So kudos for your work. I'll also say just before we dive in here, great to join you today. Really appreciate what you're doing for folks both new and more seasoned veterans. So excited uh, to be a part of it. With respect to just the evolution and getting here, Flagship was actually founded well before I arrived. It was just a collection of advisors looking for a way to simply better serve their clients and give advice that wasn't through the constraints of the broker dealer where they were. They went off, created their own structure. And interestingly enough, I was probably first introduced to them maybe 10, 15 years ago. They were a client of mine. I was an investment consultant. I worked closely with them and then stayed in touch over the years, even as territories and roles shifted. And interestingly enough, I know one of the things we're going to talk about here are just important lessons, but the one that I'd highlight, especially for the younger generation, would just be to reinforce the importance of not only developing a network, but then staying in touch. That's one of those things recognized can be really difficult to do with everything else going on, in the day-to-day grind. But the importance, particularly for building long-term success, I think is integral. And that's obviously what got me here today.
Great. Let me ask you this. So when before joining Flagship, you said that they were a client of yours. What was what were you doing prior to that, or where were you at prior to that?
So for the decade prior to joining Flagship, worked for the LPL home office, that group that partners with Flagship for a lot of the custody and technology. In that role there, would work with our larger teams and individual advisors, helping them create their investment process from start to finish. So think about the different resources, their management styles, how to do it, in compliance with the ever-changing regulatory world, how to incorporate all the different tools and resources, and then tie that into everything else that they do for clients with respect to planning and communication. So got a great experience, seeing many folks do it many different ways. I know that'll be another topic we'll hit on in a little bit, but something seeing how the really good folks do it was what I think was probably most encouraging or exciting for me. Coming over here, really being able to then embody what you see in a lot of really successful people do.
Great.
Yeah, so Eric, you mentioned that creating and maintaining a network is really a valuable lesson that you've learned. What are some other valuable lessons that you've learned along the way in your career? Starting there and now ending at Flagship and everywhere in between.
Great question, and I'd say probably the most important lesson that everyone in our industry learns, and unfortunately, this can only be learned the hard way. That is that no one strategy works best all of the time. As markets ebb and flow, so do different styles, different screens, different factors come in and out of favor. For example, you can be a world-class value manager, but if you're in a growth-led market, there's a good probability that you may lag. And so, one, I think that's why humility is arguably one of the most important traits, that you can have right along with hard work and discipline and everything else. But the most important lesson that stands out is the most important benchmark you'll ever manage against is the expectation that you set with clients. It's impossible to get every single trade right, but if you can clearly articulate, here's what we're doing and why. Certainly you still have to get more trades right than wrong, but those instances when the market doesn't play out as your research process would suggest, that's where I think setting that expectation for here's what we're doing and why, many ways alleviate some of those negative emotions from taking over. And as we know, that's what also comes with its own set of consequences, when you think about bigger picture goals and risk. So for me, it would just be re-emphasizing, again, the importance of that client communication, setting a realistic expectation with them as it relates to what you're realistically able to do on their behalf.
So when you said not everybody gets their investment strategies right, are you saying that Jim Cramer and Kathy Woods
Well, I won't go so far to name any individuals, but I will say, yeah, I had watched once that didn't have a bad aid, still told, the right place to go. Well, the track records are much ahead of that, but yeah, anybody that's telling you they never got a wrong trade probably hasn't been in this industry for that long.
Oh, I love it. What is it? A broken clock is right twice a day, right?
Yeah,
Yeah.
exactly.
Ashley, anything else to elaborate on then?
Yeah. So you mentioned risks. Speaking of personal risks, do you think that there was any potential risks that you took, in the earlier stages of your career that ultimately led to growth and success now?
So when I had the opportunity to join Flagship, was working in I'll say fairly cushy, corporate job. It had a lot of benefits, part of a team. Had a lot of things in place, and for me was definitely a little bit of a leap of faith. Coming to the other side of the table, again, easy for the last decade. I had sat here and realized when you're a consultant, you suggest, hey, here's what could happen. Very different when you're actually the one then pulling the trigger. When you're submitting the tickers and the weights over to your trading team, to go out and execute. So not only the actual role itself, but going from the corporate world to more of the RIA, your success is as much as you can dream it. The flip side to that is, there's a lot fewer assurances than there are in the other structure. And just like investing, there's a risk reward trade off. No different in this experience, but that was definitely one. I ultimately made the right decision and no regrets. But at the time, and as you're transitioning, particularly with a lot of the volatility we've had as of late, certainly a handful of nights you sit there and you question, what was I possibly thinking? Walking away from a pretty straightforward, easy gig.
Right, absolutely.
Thank you. That great answer there. And let me ask you this. So some secrets to your success. What are some of the key factors that have contributed to your success and your firm's success?
Now, again, great question, and I would say, kind of going back to that last point, where no one strategy works all the time. Recognizing that, I think to really be successful, you have to be willing to go out and constantly fine tune, constantly find a better way to do everything that you're doing. Actually, you know what? Let me pause and backtrack there. I have my notes here, and my Word document just froze on me. Literally was right there. I'm sorry. Can we run that back and start over?
Yes.
Of
Yeah,
course.
absolutely. Mike, you want to re-ask the question?
Absolutely. So secrets to your success, what are some of the key factors that have contributed to your success and your firm's success?
Again, great question. I'd say sort of expanding on that last point where no one strategy works best all the time. I think for me, one thing that really stood out was just the emphasis on trying to fine tune the process as opposed to simply focusing on the results. And that's especially true when things are going well. If you're in a challenging environment, very easy to go back and say, what did I miss, or what can I tweak? How can I improve going forward? Much harder to find that motivation to do so, when client assets are up and everyone's happy. And I think if you truly want to be successful longer term in this industry, you have to constantly look for ways to do it better at the margins. And that's more of a mentality than something that you can click on and off, depending upon how markets ebb and flow. Perfect example I'll share. A while back, I had a client ask me to build a all-weather stock portfolio for them. Went out, did a number of fundamental screens, ultimately built a portfolio, back tested it. Everything looks great. We launched it, had a ton of success in probably the first few weeks of trading, and then very quickly was reminded of another lesson of that being stocks typically revert to their mean. And that was one, recognizing that 20% swings up and down in client accounts might be more volatility than most folks were truly able to be comfortable with. That was something forced us back to the drawing board. Screened another probably 100 different factors, all of the obvious ones around risk management, handful of others that weren't. Back tested them through different scenarios, and ultimately, she came up with a few combinations that had fairly high predictive abilities. And as a result, that's something that's now included in our security selection process. But as I think back through the time frame, when we originally launched this, it had a great deal of success right out of the gate. Finding tweaks or ways to improve this, probably the last thing on my mind. In hindsight, though, certainly wish that we had. And going back to a point earlier, it's those lessons you really only learn the hard way that ultimately you hopefully get better from.
And would you mind elaborating on, you said back testing and lessons learned. Can you elaborate on that for a moment?
Sure. So as I mentioned, when it started, looked at a lot of the fundamental screens. It was all right. We want stocks that are attractively valued in value-led markets. We want stocks that offer above-average growth potential for a growth-led market, and by that try and create a all-weather. But in that portfolio, didn't pay any attention to risk management. Well, turns out those stocks were arguably a little higher beta, a little more concentrated, and again, not taking that diversified approach. Very quickly, when sentiment changes, you realize can work against you. What we did, and as I mentioned, went back to the drawing board and looked at probably 100 different metrics, looked at analyst ratings, looked at momentum, look at what percentage of shares are being shorted, put to call ratios, looked at the trends in those different patterns, ultimately going through thousands of different combinations to really see, all right, in different market environments, which of these factors or combinations of factors was consistently ranking among the top performing stocks. So, in essence, sort of backing into, as opposed to saying, all right, what are the factors that drive success? Let's look at the stocks that are working and what are the unique story? What are the factors that continually show up with those names? Then backing into how do we tweak our investment process to really start with the end in mind, to give us exposure to those factors that ultimately are rewarded, particularly over shorter periods of time. I think the one thing nobody really talks about in our industry is we can say all else being equal, a stock that has the same growth potential as the market, but is trading at a lower PE. Generally, depending upon how efficient the market is, that stock, all else being equal, would likely outperform. What a lot of folks, I think, don't focus on is over what time horizon. Again, you can be a great value manager, but there can also be a decade where growth leads the way. And so, thinking not only how predictive are those factors you're looking at, or how predictive are those abilities, but also over what time horizon, and ultimately then making sure that you're positioning a portfolio that's going to put your best foot forward based upon the environment that you're headed into.
Well, I really like what you said there, because it hits home with me personally, right? So you had mentioned the put to call ratios and shorting. Obviously, if you're looking at, and especially over the last the pandemic, when you had some companies that were trading at, you know I saw things as high as, and you probably saw things that trade at higher than 12, 1300 multiples. I remember Tesla was trading at like a 950 PE. And so obviously the short float, if the short float's high, would you would you mind explaining the put to call ratio, and do you you know, I don't know if this is the appropriate question to ask on the podcast, but do you think that it's manipulated by the big funds at all?
So great question. Starting with the first piece, so ratio, obviously, you have in the derivatives market, there are instruments that you can speculate based upon anticipated upward pressure or upward movement in prices. Conversely, protect against downward movement. And so those ratios, in essence, a way to sort of gauge market sentiment with respect to the outlook of an individual security. If you expect, if there's a strong delta one way or the other, that is likely suggestive over the anticipated net move for that particular stock or ETF index, whatever that underlying instrument is going to be. When we think about manipulation, sure, that probably does exist to some point. I don't know that I have the data to help support a strong claim one way or the other. But at the end of the day, why we take a multi-pronged approach is for that very reason. Certainly, some variables or some factors could potentially be manipulated, but if you have multiple inputs, particularly that are uncorrelated with each other, that, in my opinion, increases the predictive abilities. And so there are going to be times where those ratios maybe aren't truly reflective of the outlook for a particular instrument, but that's also okay. Our model isn't designed to capture every single stock that appreciates greater than the benchmark. We're looking for consistency, and we're looking to protect capital and certainly grow when there's opportunity to do so. And so by having that sort of third leg of risk management, that allows us to at least weed out those names that suggest some caution is merited, more so to avoid those catastrophic implosions, many like we saw earlier this year in the regional banking sector, as opposed to simply making an investment decision based on one metric that, to your point, it could potentially be manipulated by some of the larger players.
Gotcha. Thank you for that answer. And you know, my last question on this topic is, how do you measure success as a financial advisor?
Yeah, so this is another great question, and one I was actually going through a workshop years ago. And the question is, how do you define success? And that can mean a lot of different things to a lot of people. To me, success is the people that I'm accountable to are glad that I'm in their corner. And so, whether that's my spouse, my children, friends, family, clients, business partners, acquaintances, whatever it is, the end of the day, if I'm accountable to you and you're glad that I'm in your corner with you, to me, that's success. Certainly, our industry measures sales goals and retentions and growth and performance, not in any way to suggest those factors aren't important. But to me, it's more of that qualitative. We're still in a relationship business at the end of the day. If people are glad that you're in their corner, doing the work that you're doing on their behalf, to me, that meets my definition of success.
Thank you.
I like that. That's great. Yeah.
Yeah.
I think that it's like you say, it's a relationship based business, but everything in life is relationships. So as long as you can foster, great relationships where you can be there in the corner, they'll be around for a while. So kind of going into
Absolutely.
more relationship things. I mean, you're a leader. You're a chief investment officer at Flagship. You also are the managing partner at TrestleBridge. What's your leadership philosophy, and are there any specific leadership lessons that you've learned in your position that you think are helpful to share?
Sure. And as Mike sort of mentioned at the onset, I mean, I played sports my whole life through college. Being a graduate in 2008, I got to work for a handful of organizations in my first few years in the working world. And all of that to say, I had a lot of experience with leaders, good, bad, and indifferent. As I was preparing for this, thinking back through those leaders that really stood out, the folks that you'd be willing to go to war with, there's one thing that started to show up, and one trait they all had in common is you kind of felt they would do the same thing for you. And so that, when I think about the team that I have a privilege to be a part of, is probably the number one trait that I like to embody. Certainly, at the end of the day, leader, you have to give your people the right tools and resources and coaching and everything else that comes with a traditional employee structure. But at the end of the day, if you are truly asking somebody to give you their best, they have to know that you're going to be willing to do the same for them. That when things get tough, you're going to dive into the trench and fight alongside to do whatever has to be done to get through whatever that challenge is. And as I think back, whether it's a coach, whether it was a manager, whether it was somebody in a different department, frankly, the people that you were willing to really lean in for, in my opinion, were those that you felt like they would do the same for you.
Right
Absolutely. I
on.
feel like a lot of people could agree with that statement, with the leaders that they've had in their life and the more favorable ones. So, with that, is there any challenging parts you see as being a leader in your position?
Absolutely. And particularly when you think about how our industry constantly changes in order to be successful, you need to be able to go out and change along with it or evolve, innovate, whatever the word of choice is. And anytime that you try new things, you're bound to come across a handful of challenges. What I would sort of, my biggest takeaway in doing that is encourage folks just to stay focused on what got you there in the first place. Why are you doing this? Use that as sort
Right.
of your motivation or your fuel to push ahead, through those challenges that inevitably come up. It's the line from Edison who said, as he had the many failed attempts trying to invent the light bulb, I found 10,000 ways that it doesn't work. Obviously, his focus was wanting to transform the modern way of life, and that for him propelled him to keep trying different combinations, trying different things, and ultimately get it to work. I think again, sort of going back to that concept of humility, but also the mentality of simply trying to find and want to find a better way of doing things. You got to know you're gonna come across some challenges, but at the same time, know there's some reward for you there when you do ultimately get through it.
Right.
Thank you. I would like to add something in there. In your position as a chief investment officer, um, I know that this question might be a little bit off topic, but um, are you responsible for the direction of the investments that your firm moves into, or is it a collective decision? Or
Yeah, so it's definitely more of the latter, and by that we have a handful of different strategies and approaches, and so some more of a group, some more individual based on the different backgrounds and experiences, traits, skill set of the different individuals on our team. At the end of the day, though, it certainly is a collective effort, and so as much as you can have a strong view one way or the other, recognizing checks and balances, recognizing again, going back to a point earlier, my particular strategy and background, no guarantees that works in every environment. Particularly in a year like 2022, where a lot of fundamentals didn't necessarily work. That
right.
was a time where you wanted to have that multi-pronged approach, so to speak, just to make sure that you weren't missing anything overly obvious, and hopefully at the end of the day that translates to better outcomes for clients.
Yeah, because the in 2022, I think we talked about this on the previous podcast. It was I think he said 4 times in the last 100 years or in history that that the bond market and the stock market had both you know uh, plummeted at the
Double
same
digit
time.
declines, yeah,
Yeah.
which it's difficult, and even going back to something we talked about earlier of setting expectations. For most clients, a 60-40 portfolio, well, we have the stocks for growth, we have the bonds for defense, and you try and do a review at the end of the year, and nothing worked. There were literally days where the 150 tickers that I follow and all the trailing time series, literally just a sea of red. And that's a really difficult environment. I think it goes back to setting the expectations and just the importance of communicating with clients so folks are never caught off guard with oh my God, what's happened over the last 12 months, and what does this mean with respect to what I'm trying to accomplish in my life?
Right. And what did you? I mean, what did you attribute that to? How come there was that double whammy that happened?
Okay. As you go through the historical, comparisons or correlations, obviously when stocks sell off, bonds tend to appreciate. Obviously
Right.
past performance no guarantee, which we see in the bottom of every statement. The exception to that rule is when it's a drastically higher rate regime that's also weighing on stocks or being the catalyst to stocks. I think traditionally, as an economy grows to the point where inflation ticks up uh, above certain targets, that's where we now ratchet up interest rates to control that. But if you have a steadily growing economy, generally that is supportive for stocks. It's truly when you get into these unique situations, which we had following the pandemic, a lot of stimulus coming in. That had a very inflationary effect. You saw stocks, particularly in the tech sector, rally very, very hard. Valuations become stretched. And now all of a sudden, everything you did to get you through the pandemic, that was now kind of come and due. And unfortunately, all happened at once, which, as we know, resulted in some pretty difficult conversations, towards year end.
I could only gosh, I could only imagine, what you guys were going through. I mean, not just you guys, everybody in the RIA space. I mean, put it this way, me included. I have a financial advisor, and I would refuse to get on the phone with them because I didn't want to know how much my portfolio had went down. I was like the ostrich with my head buried in the sand. I said, you know, I just want to know when it's back, when my portfolio is back to what it was when I first came to you guys, right? That's it. And yeah. So it was a tough time for sure. So I could imagine you had, thousands of Mike Mershaw's days calling you guys up, and they never pat you on the back for the prior year where you probably had gotten them 30+% returns, or even greater, but you certainly got backhanded as soon as the portfolio went down.
Yeah, they say if you graph the net emotion of a dollar gain versus dollar lost, if the gains plateau, the losses only increase exponentially. And so, yeah, to your point, yeah, double digit gains, hey, great, yeah, good work. Goes the other way, which, yeah, law of probabilities is set to do every 0.8 out of 3 years. Yeah, that's one, particularly when you haven't had a ton of volatility or at least sustained volatility, the pandemic notwithstanding. I think that was also just very difficult for people that weren't used to it. And again, another lesson, lack of volatility does not mean stability, but the same vein, when stocks only go straight up, you're not worried. You don't feel that emotional, pain of seeing red on the statement. It is unfortunately very easy to get used to that. And unfortunately, then when it does come back, it makes it that much worse.
Yeah. Um, so I'd like to get into the next question there. What do you see as the future wealth management? What does the future wealth management look like? How do you envision it?
Again, another great question. When I think about the future, there's a lot that can and will continue to evolve. You look at just in the product space, take ETFs for example. That used to be a passive collection of stocks mirroring an index. You now have very advanced alternative strategies available in these vehicles that tend to come with greater transparency, more tax efficiency, and lower cost. So I think you're going to continue to see a product world that, all else being equal, greater benefits, the end investor. You've even seen, some of those ETFs now come without internal expenses. When we really think, though, about the opportunity within the industry, for me, I'm sort of biased, but would go back to technology in or around or somehow tied to improving both the client communication but client experience. We live in a digital era now more so than ever. Need to be able to meet clients where they are, proactively bring them those ideas, those topics that are going to be relevant to them, as well do that in a way that's very efficient. I feel now more than ever, people are busier than they've ever been. There's less free time, and so finding a way to add value to clients, to do it on their terms, and to do it efficiently. I think it's the individuals, the organizations that solve for that are the ones that you're going to see start to run away from the pack. Now, one example, you think historically, it'd be a volatile period in markets. A lot of advisors will lock themselves in their room and turn their phone off. They don't want to have to answer those difficult conversations. Well, that's now evolved. One thing that we do is proactively put together a 7-minute video every other week. Here's all the highlights. Here's what's going on. If we make any major shifts or trades, we'll talk about it there. More so as a way just to set expectations, proactively bring that to clients. I can't tell you how many client questions that addresses before they pick up the phone. And again, you think about being scalable, being able to grow, add more value to more people and organizations. You have to be able to do that at scale. And something, again, not that volatility is ever easy to stomach and experience, but where we like to think did a very good job communicating, setting expectations with clients. I think that at least allowed individuals to understand what was taking place and why. That at the very least, hopefully helped to mitigate some of that emotional response when you open up and see, oh my God, both stocks and bonds are down. Where do you possibly have in this environment?
I mean, and that leads me right to my next question there. What key trends, strategies, or potential technologies do you see shaping the industry?
Yeah, so another great question, and I know we're going to talk about AI in a little bit. That's something that certainly ties in here, but I think there's one when we think about being able to communicate, when we think about being able to truly understand a clients where they are, their emotions. One example I'll share: we have a software system that will track how many times clients log in and view their statements. Now, not surprisingly, when volatility spikes, you tend to get a little uptick there. But if we see a client has logged into their account 486 times in the last 2 weeks, with the last login occurring at 3:46 on a Tuesday morning, if that aligns with volatility in the market, there's a pretty good chance that they're nervous. They're not sure what's going on, and this system has actually allowed us, going back to a point earlier, proactively make some phone calls, and I can't tell you. There's a very high correlation between people that check their accounts at 3:48 in the morning and those that are also experiencing some concerns around volatility. And being able to understand that, detect that human behavior, that emotional response to what's going on, but to have a system be able to alert us and proactively place that phone call. I think it's things like that. At the end of the day, going to go back to helping reassure clients we're in the right model, you're on the right track, you're on a path for success, but being able to navigate the emotions and using technology to do that in a more scalable, more efficient way.
Gotcha. Thank you for that. You know what? And speaking of AI, that was actually the next sector we're going to get into, and so I'll let Ashley take that over.
Yeah, and that software that you mentioned, that's so smart. Like, who would have thought of that?
Well, do they really?
Yeah.
Wait, let me chime in real quick. Do they really log in 400 times in a couple weeks?
There's no way to see how much of that is automated, with the other planning things linked. But there have been a few occasions where, either the cat got a hold of the computer and just kept clicking the mouse button, or who knows? But maybe anytime you proactively log a phone call, people are appreciative. And who knows? But at least in our experience, been a pretty high correlation there.
That's funny. So going into AI, how do you see AI possibly impacting the wealth management space? Like, do you see it possibly enhancing the client experience? Or I know some people are a little more set back from AI. they're kind of
Excellent.
undecided on how they feel.
Great question. And when I think of AI, I look at it through two lenses. First is what potential does it have long term? And then secondly, what is it actually able to do today? So there's been a lot of comparisons between AI and the internet. I think if you went back to the early days of the internet, and even the folks that were very gung ho there probably couldn't ever imagined that it became or would become what it is today. And so I think AI certainly has the potential to do that. I don't think we're going to know exactly what that looks like or what that will do until it gets here. I'm certainly encouraged though, and again, anytime you can innovate, typically that is encouraging for companies' bottom line. That being said, as a fiduciary, very difficult to allocate client capital into something that could potentially maybe be one day, very down the road. And so, with that in mind, when I look at AI today, the benefits that it has, you know, the ability to analyze large quantities of data to aid in the research process. I think about companies, industries, sectors that are very labor intensive in those areas. And immediately, this provides that boost to productivity. Again, all else being equal, company that's run more efficiently going to have a better impact on the bottom line. One very interesting trend, though, as we look, so probably the first 6, 7 months of this year, for all the talk of AI being the next catalyst, for the bull market ahead, interestingly enough, vast majority of the year-to-date gains were truly isolated to those companies involved in the manufacturing of AI, a la the mega cap techs, as opposed to the broader industry. And I think that's going to be a very interesting trend to follow. Again, what impact does AI have? Time will certainly tell, but at least from a market performance standpoint, I haven't necessarily seen the market reward those other 494 names in the S&P that weren't directly tied to its manufacturing.
Right.
Right. Well, do you see it by chance impacting how financial services are delivered? I know you say like with the investment side, but using AI as a consumer to help improve your business processes, do you see any benefit there? Or do you think with this predominantly relationship based business, it's really not much room for AI to come in?
Again, great question. I think time will certainly tell there. You think about using a robo advisor as sort of a proxy for AI. Who knows what exactly AI will be able to do down the road if that's create better financial plans or more efficient portfolios. Certainly, a lot of that technology exists today. I'm sure as AI evolves, those processes will only get better and smarter. The end of the day, though, as we talked about earlier, this is a relationship business. And so for clients with very low complexity, I think being able to talk to a robot, a machine, and have a conversation with a automated, chat box, for many people, sure, that'll be fine. But if you have a much more complex, scenario and you're thinking about making a major life decision, such as retiring from your employer of 40 years, my sense, or at least in my experience, is being able to sit across the table from an individual, to look in their eyes, to be able to go through all the numbers, to let them know, here's all the things that we explored that ultimately go into our recommendations for why it is okay for you to retire. I think that assurance, again, falls much more in the emotional camp, and not quite sure that AI or quant or technology can deliver that to the same extent that a human being can today.
Gotcha. Yeah, I like that. I like that answer. You know, because you're right. That's the one thing AI it's not going to be able to do is you know, convince humans of the decisions that they should be making. That's going to affect the rest of their life. I think
Right.
that takes a human. I think that takes a human to have some sort of you know uh, delivery to another human when it comes to that sort of life decision.
But then
Yeah.
again, and even going back just to that emotional piece, where the computer can very easily say, this is the risk tolerance you should be in. Now, this is what makes the math in your financial plan work. If you have a client where they're in a aggressive portfolio and volatility ensues, they decide they want to sell because they can't take it, and they lock in those losses, wait for markets to recover before getting back in. That I think is the classic example of human emotion, taking over and resulting in some very poor outcomes. Again, not sure a computer is going to be able to talk a client out of doing that, particularly one in a highly emotional state. That goes back to the old adage that you know logic will never trump emotion, and so having
Right.
that human element, being able to talk through, here's why we're doing what we do, here's what historically the data suggests, this is why it still makes sense. Not that portfolio tweaks don't need to happen, and by all means need to take into consideration what clients are telling you. But at the end of the day, that emotional piece, particularly around decision making, I think often is overlooked. I know Vanguard has a great study trying to quantify the benefit to an advisor. And I want to say it's something in the ballpark of 400 to 500 basis points on an annual basis, working with an advisor to talk you out of making poor emotional decisions. That was sort of the excess return in a given year, each year, every year. Try and imagine compounding 500 basis points over a investment time frame of 30 years. That's going to put you in two very different scenarios by the time you decide, okay, it's ready to retire.
Gotcha. And gosh, I would like to delve into probably one or two more questions here, and you know, just get your take on it. What do you think is in store for the economy, near term and long term? If you could, maybe provide some of your expert insight on the state of the economy, the debt load, um, in helping our listeners make some more informed decisions, that'd be great.
Sure. Yeah. So beginning of this year, there was a lot of debate. Are we soft landing? Are we going into recession? Clearly the soft landing camp was proven correct, at least as of date of this recording. The more important question though is where do we go from here? Certainly, economic growth has been resilient through this point, in spite of many macro headwinds. But as we also all know, a lot of those headwinds, don't take effect from day one. You have those lagging indicators, current ones, and then leading. A lot of the leading indicators have started to soften quite a bit. To me, that does give a little bit of pause. Now, I'm also reminded, the stock market is not the economy, and
Right.
more importantly, the stock market doesn't trade on whether things are good or bad, but rather they're getting better or worse. Yes, inflation's coming down. Yes, unemployment is low. Yes, GDP growth has been in the last print above average. All of that is very encouraging. The question, though, where do we go from here? And as that sort of parlays into the market, a lot of the gains year to date have been more on the sentiment side. So expansions to PE or price to earnings. So from a valuation standpoint, as opposed to growth in those underlying earnings, which when you boil down the company's income and balance sheets at the end of the day, what they produce. And so with so much good news priced into markets today, we almost have to have a perfect environment play out to justify the levels where we're at. I think that
Right.
does potentially expose us to some downside volatility. Should that environment not materialize. Then again, though, you go back to setting expectations with clients. Never live in a binary world. We live in a world of probabilities, and try and make a good risk-adjusted uh, probability wage decision. And where there's certainly scenarios we could navigate this, and the Fed could engineer a soft landing. I'm probably a little biased to think may have a little turbulence ahead, just based on everything that's taken place that hasn't necessarily made its way into the market and into the economy as of yet.
Would you mind elaborating on what hasn't made its way into the market yet?
So I think the biggest thing we talk about interest rates. We're in the camp that they're going to stay higher for longer and maybe even move, a few more hikes depending upon how data comes in the quarters ahead. But we think about the housing sector. You haven't seen home prices implode as you normally would expect in an environment where rates are so elevated. A lot of that is a function of
Right.
a lot of people aren't willing to move because they're going from a 2% or 2.5% interest rate to 8. That's a
Right.
scenario
Right.
where the math doesn't make sense, and so you haven't necessarily seen that play out. Another example would be, companies that have a lot of debt that's maturing in the next 6 to 18 months. They're now going to be forced to refinance that at a materially higher rate than they likely did back in 2020 when rates were cut down to zero. Obviously, any dollar that you pay higher in your capital cost takes a direct bite out of your profitability. And so it's those companies that on the edge of profitability that had a lot of debt that don't have stable cash flow. Those are the ones I think may be a little vulnerable as rates stay elevated, forced to refinance some of that debt, particularly if we don't get that macro tailwind from a growth perspective that the market is in many ways pricing in.
That's a great answer. I never factored in major corporations having to refinance their debt, and that leads me into my last question there for you today. What investment opportunities or sectors are currently capturing your attention as a chief investment officer, and interests you the most? Like, is there maybe any emerging markets that you believe would be that hold great potential for growth in the future here?
Yeah, so well, I'll give you two answers. From a bottom up perspective, we prefer companies higher quality, very strong cash flow. Those are the companies that likely don't have as much debt, also have the ability to finance a lot of that expansion internally, and therefore higher rates aren't as much of a headwind. Those are also organizations tend to be more established, less or more immune to the fluctuations and cyclicality. From more of a top-down standpoint, yeah, when we think from a regional perspective, sure, the U.S. market is expensive today when you look at it, as a whole. But for me, I always struggle with the argument. For us, the bias is or the hurdle is a little higher to go offshore, and so we think about what is the decision to own international emerging markets? Is it simply based on valuations? Is it based upon a thesis for a falling dollar? Or is it based on the expectation for above average growth? On the intermediate term, we're probably dollar neutral, long term dollar bears. And so I think that eventually will be a tailwind for some of those more emerging companies or countries, rather. But for today, I'd rather own a neutrally valued mid cap company with, in my opinion, has better growth potential than some, offshore. I think the regional standpoint is also very difficult when you start to add in some of these geopolitical themes. That's something impossible to sort of forecast. At the end of the day, that's why there's a risk premium. But for us, I think our focus or our bias rather would be to find what are those attractive opportunities in a market that ultimately we're more comfortable with. To your point, though, on higher level themes, one, the concept of onshoring, where we're bringing a lot of that manufacturing back, both to the U.S. or to the Northeast. You've really seen that in Mexico's stock market performance year to date. Another theme, AI that we talked about, going to be very interesting to see what new services, what ways of interacting business come out of that. I certainly put that in the cyber technology space, and one that can certainly be volatile, but one my expectation would be over longer periods of time will continue to reward investors. The last thought that I'd leave you with would just be around the concept of green energy. That's funny. You're now hearing a lot of those traditional energy companies, talking about their green mandates, and even within that, just electric vehicles. A decade ago, if you knew somebody's politics, you could be pretty sure on their opinion towards an electric car. I think you're now seeing a shift across the board of folks looking for more sustainable, arguably better ways to do things. And electric vehicles have a lot of challenges, a lot of work to be done and challenges to be resolved. But I think at the end of the day, you're never going to flip a switch and everybody's driving an electric car. That being said, it's also difficult to envision a scenario where they lose market share going forward. That's certainly something or a theme that we view very favorably.
Yeah, I mean, look, I'll be biased on that piece for just a second. I think it's a great sector. I owned a Tesla for about 5 days, and I almost torched it. That thing had me stranded. It said I had 200 miles, and I think I went 86 miles, and I was on the side of the freeway calling up my assistant, cursing the very, just cursing this vehicle. I was so upset with it.
I think there's a class action suit out there, so that's
Should look into that
sure
one.
you get your name in the hat there. But yeah, going back to something we said earlier, when did you ever get something right in the first try? And
Right.
particularly when you're trying to innovate and do something brand new, as the Tesla many years ago was. And so again, just like anything, there are going to be challenges, but as you have people, particularly with Tesla's CEO, who's very innovative, in the same vein, they're going to work through those, and they're ultimately going to find a way to get it done. Just may never happen in the time frame you want.
Right. Right. That's thank you so much. You're a very intelligent individual, and I feel like I could sit here and talk to you all day. I've taken so much from our conversation today, and as we wrap up, and debrief, we'll stay on here for a couple minutes, and I'll let Ashley take over from here.
Yeah,
Awesome.
well, thank you so much, Eric. I feel like we could talk forever, as Mike said, but I know we both learned something, and I think our listeners gained a lot of valuable insights. So we appreciate that. And to our audience, thanks again for tuning in to another episode of the What Matters podcast, where we only talk about one thing, what matters.